You say in the notes that I was given that the bear market is getting tired. What's your evidence for that?
Well, one of my trusted staff members, Dylan Hoover, walked in my office today and said, I can't take this anymore. I can't listen to one more story about the Fed and all the problems it's caused. We're beat up by this whole macro thing, and it makes sense. It's gone on now for well over a year. The market's been down. And what's interesting is it's kind of all we've got left. Well, the next year would be good if, and then some narrative about the Fed. And what I find fascinating is it's such a dramatic change from where we were a year ago on the macro level. And what it's done is completely confuse and set out all the micro level, company level stories that have really become intriguing investments here. And that's why is an opportunity. And let's just start focusing on stocks.
I'm not sure you answered my question, Jerry. I am definitely sure that there are some intriguing stories in equities right now. Look at Netflix. It's had a very, very good month. And there are other examples of individual shares that have done well for particular reasons, Biogen among them. But I asked about the bear market. And your claim that it is getting tired. Where, again, is the evidence of that beyond a colleague of yours who says, I'm sick of hearing about the Fed?
Consumer non-durables have stopped outperforming. Utilities were one of the biggest down groups in the down market yesterday. When you look at the places where you've gone to hide, when you look at the flows of capital, it's leaving bond funds now. It's not leaving stock funds. In fact, the flows into stocks have increased and are accelerating. So the things that would let you believe that there's more stocks to be sold, then that would give you more long-term evidence of a bear market. Those are starting to go away, and they're giving rise to all these interesting green shoots.
All right, let's talk a little bit where you see an attractive risk reward. I want to go first to Las Vegas Sands, which is a company that I cover, and it's a company that I know a lot about. But I just want to lead into this. Las Vegas Sands is part of a broader group in gaming where there's been generally a real disconnect between what the companies are reporting in their earnings and what the stock price shows. So, Jerry, talk a little bit about Las Vegas Sands. What do you like about it?
Yeah, I mean, like a lot of these stocks right now, they're trying to discount 2023, mid-year 2023. If you look at what is on the horizon, so in this case, this company doesn't have to worry about Las Vegas, even though it's in the name. They're focused on Singapore and Macau. They just announced last week that one of the provinces would open for people to go to Macau, and the stock went up 6 points. You think about the number of provinces there are in China that you could open up, and you get the feeling that unlike the rest of the global economy, China could be in great shape a year from now, 9 months from now, and this would be one of the great names to own.
Well, Las Vegas Sands missed out on that huge rebound in Las Vegas by selling it. But what they got was a lot of cash to sit on to tide them through this rough spot. If we see a rebound in Macau, like we've seen in Las Vegas, they're set up well. What about PayPal? Why do you think that the bad news has already been baked into this and it could just be upside from here?
Yeah, so PayPal 2 years ago was one of these glamour growth names that was going to capture every part of connecting payments to all sorts of things, including crypto and everything else like it. The company even looked at hard at an acquisition that would have really sent them in the stratosphere. In the course of that process, they have now decided to go back to their core business, focus on a 20-25% growth area that throws off a ton of cash, and stock's down 65%. So we don't have to look at this as a company that needs to grow 30 or 40% anymore, but a really powerful cash machine at a 20% growth rate.
I acknowledge that there are interesting stories like that. I conclude with one more of the notes that I have. It's time, you say, to gear up for the next big market up leg. What is going to trigger that when you've got a strong dollar that companies are now saying are impacting their margins, when you have profit challenges, when you have rates rising, and you have a war in Ukraine that is not getting better?
Okay. How much of all of that has not been discounted? That's the big question.
I don't know about the war, Jerry. I do not know about that because I don't think it has been sufficiently discounted personally. Because I don't know, because none of us know what Putin may be capable of.
Yes. And that's why you look at all of the risk that's been priced into this market. You look at what's potentially going to come, which that includes. But you also have to balance the names like we just talked about. And the things the Fed can't affect. It's not going to affect the tightness in the global oil markets. Not going to affect people going to Macau. It's not going to affect Lilly or some of these great drug companies who have really interesting therapeutics right now that haven't been priced into their stocks. So if we do it stock by stock and not worry about some of these overviews that people are taking the worst view of, I think you'd find that there is a lot underneath in this market right now to focus on. And why not do it? Instead of focusing all of our time on the Fed and the war and the dollar, let's talk about individual stocks because that's really, in the end, what we own.
Jerry, always good to have you on. It wouldn't be fun if I didn't push back a little bit. Jerry Castellini, thanks so much.
You bet.